Hi, this is Mike Larson for Money and Markets TV. It's been clear to me for a long time that the U.S. economy is following the Eurozone into recession. But now, even Federal Reserve Chairman Ben Bernanke is acknowledging the strong headwinds we're facing. In his semi-annual testimony before Congress this week, he said that we're just, quote, muddling through, while most of Europe is already in recession. He noted that GDP grew at a slower rate in the first quarter than in the last 6 months of 2011, and that the second quarter looks even worse. He pointed out that payroll growth has plunged by 63%, that household confidence in future income remains low, and that business spending is slumping. And several other commentators are even more pessimistic. The International Monetary Fund just cut its global growth forecast for 2013, citing Europe's downturn and the slowdown in emerging markets. Goldman Sachs just slashed its U.S. GDP forecast for the second quarter from 1.3% to just 1.1%, on the verge of stalling out entirely. PIMCO's bond king Bill Gross just said the U.S. is, quote, approaching recession when measured by employment, retail sales, investment, and corporate profits. And the prestigious Economic Cycle Research Institute says the U.S. economy is already contracting. Now, despite all that, stock traders and the so-called experts on CNBC are telling us to ignore that, because Big Ben is going to swoop in and save us all. I think that argument's nonsense, because if you examine the tools that are actually available to Bernanke, it's obvious that he can't do anything to improve the real economy. The first step that Fed policymakers could take would be to cut the interest rate paid on excess reserves that banks hold at the Fed. The goal would be to get the banks to lend out their reserve funds rather than just parking them at the Fed. But the interest rate is already at 0.25%, so cutting it to zero won't make much of a difference. If anything, it could hurt the economy by driving money market funds out of business, draining a vital source of savings. Bernanke also said the central bank could use communications tools to guide market expectations. That's just jargon for promising to keep rates low for longer than the current time frame, which is at least through late 2014. But nobody expects a hike in the federal funds rate anyway. Not to mention, they know that the Fed's promises aren't worth the paper they're printed on. Finally, Bernanke said he could consider another round of quantitative easing. This is the bulls' biggest hope. They assume that as soon as the Fed pulls the trigger, the stock market will be off to the races. But as we've seen, QE2 had much less of an impact than QE1, while subsequent programs that are kind of like QE, including the ECB's long-term refinancing operations and the Fed's two-operation twist plans, have been even less effective. Yet somehow we're supposed to believe that QE3 will somehow be different. Look, even if the program succeeded in lowering yields by maybe another 10 or 20 basis points, can anyone really argue with a straight face that that will make a major difference on the financial markets or economic outlook? I think those are bad bets to make, and that's why I continue to remain cautious on most stocks and asset classes. I'm Mike Larson for Money and Markets TV. Thanks for watching.